Subscribe to the channel and press the bell icon to never miss any updates. The performance of mutual fund reflects the performance of fund manager. That's why you need to be careful while selecting mutual fund because the returns are heavily dependent on the fund manager. Hey everyone, this is Anuj Vohra, and in today's podcast I will be going to talk about the role of fund manager in mutual funds. So without any further ado, let's get started. I have seen lot of people who generally track 3 to 4 years of data regarding the returns, and they just invest on the basis of that particular data. They don't look at the name of fund manager and the performance of fund manager and the past records and also things. After a few years, the same investor realized that it was his mistake and it was not a wise decision to focus on the 2 to 3 years of returns, and I needed to check at least 5 to 7 years of the return. That is why you need to be careful while choosing the best fund manager for you. And also, if the fund manager is really good and he left the AMC, he left the fund, then there are chances that the fund started performing poor because the new fund manager takes time to understand how that particular mutual fund works and what are the asset allocation in that particular mutual funds. That is why you need to make sure that the fund manager is going to stay for the longer period of time. It is difficult, no doubt, but let's say if there is a same fund manager who has been performing well for over 7, 8, 10 years of period, then that particular fund can be the right option for you. Now when you invest in mutual funds, there are fund managers who manages your money. You may think that what about the mutual fund agents and mutual fund distributors? They don't manage your money. They guide you where to invest so that they understand the risk taking profile of yours and they choose you, they give you suggestion where you should invest in order to get optimal return what you can expect based on your risk taking ability. So the fund manager manages your money. That means if you have invested 100,000 rupees in, let's say, equity mutual funds, then the fund manager will allocate your money to 30, 40, 50 companies based on the stocks which he has selected. Now you may ask me that how is it possible to invest in 30, 40, 50 companies if I have just invested 100,000 rupees? Look, it is not only about your 100,000 rupees, there are billions of rupees which he manages. That is why what the actual task of fund manager is to buy and sell stocks based on the stock performance. Fund managers analyze stocks. They have a team of 10 to 15 people. They check financial statements. They check the fundamentals of particular company, and based on that, the fund manager decides that whether to buy that particular company or not. And there are times when fund managers sell stocks which are not performing well. So basically the task of fund manager is to buy and sell stocks and give the optimum return. Now you may ask me the question that if he is buying and selling stocks for us, then what is the problem if we do the same thing instead of investing in mutual funds? Look, this question is really obvious, but if you understand the core fundamental thing that you are investing in mutual funds because you don't know how that particular stock works. You don't know the fundamental analysis, you don't know technical analysis, you are not aware about short-term volatility, you are not aware about how much risky it can be if you invest in any particular stock. That is why if you try to do the same thing, there are huge probabilities that you may end up losing a lot more money, or your returns can be lower than the inflation rate. On the other hand, if you are good at fundamental analysis, technical analysis, understanding the financial statements, understanding the future probabilities and future advantages of investing in that particular stocks, then it's good to go. You are good to go for not investing in mutual funds and have your own investment portfolio. But we live in a busy world, so most people don't prefer to do such kind of analysis. They have different job other than financial sector, so they are not aware about all such things, and that is why they prefer to invest in mutual funds. And mutual funds allocates a fund manager who manages the money of thousands and millions of people. The expertise of fund manager helps the investors to create wealth in the long run. Even 10 and 12% return are good, because if you look at the inflation rate and the rate of GDP, if you give the addition of inflation rate and GDP, that can be the best return you can expect from the stock market. That means the inflation is 5% and the GDP is growing at 6%, then you can expect 11% return from the stock market easily. So the fundamental task of fund manager is to beat the benchmark. That is, here I consider that 11%. If the fund manager has been providing more than 11% return, then it is good to go. You should stay invested in that particular fund, because the track record of that fund manager is, we can consider, really good. And if your fund manager is really good, basically it depends on in which funds you invest. Let's say if you invest in mid-cap funds and the returns you are getting is 14 to 15%, then it is good to go. It is a good fund track record and you should stay invested. And as you are getting 14 to 15% return, then the chances of getting wealthy also increases. So understanding all such things, you need to be careful while choosing the best mutual fund option for you. If you just look at 2 to 3 years of past track record and based on that you invest in any mutual fund, then there are chances that after 2 to 3 years of investment period, the fund manager change his job and he just shifts to another fund, then there are chances that the return you are expecting would be go down. So this is what you need to understand about the role of fund manager in mutual fund, and what are the things you need to look before investing in any mutual funds. So I hope that helps.